Hello and welcome to this presentation, Futures Settlement Price. In previous presentations we looked at the idea of how a buyer and seller of a futures contract can work out the correct hedge ratio in order to manage their underlying exposure. But we also came to appreciate that the seller of a futures contract has a number of choices when it comes to deciding upon which type of asset from a deliverable list the seller can choose to deliver. And also we know that certain futures contracts enable the seller of the future to decide when in a particular delivery month they choose to elect to deliver. That could be the first business day in the month, the middle, somewhere, or the end. And of course there's also the issue of where in the world potentially delivery may take place, because with commodities, for example, which are grown in places like Africa or South America or in Asia, the seller of the futures contract could choose to deliver in any particular location. So what it means then is that the buyer really is at a disadvantage, because the seller can choose where in the world, when to deliver, and differences in the quality of the underlying asset. So to make delivery process equitable, we need to make adjustments to the final futures price so that in theory the buyer and seller of the futures contract will be indifferent as to which asset they choose to deliver. And we can do this through a process known as the conversion factor or price factor. So what we're going to do now is just to look at a sort of generic approach to how we could go about making the delivery process equitable for both buyer and seller. Suppose then, in this simple example, we have three types of underlying asset that could be delivered into a particular futures contract, and we'll classify them as class 1, class 2 and class 3. And we notice that class 1 asset is a premium quality asset, whereas class 2 is standardized, a standard product, and the class 3 asset is, let's say, of an inferior quality, in other words a discount. Now we can see associated with these different classes of assets a number, a conversion factor. For example, if you deliver the standard asset into the futures contract, we'll see that the final futures price that we use to settle the futures contract is going to be multiplied or adjusted by a factor of 1. And of course, if you multiply the final futures price by the number 1, it doesn't change its value. And nor should it, because what we're assuming here is that the futures contract is based upon this standard asset. Of course, the futures contract also allows for the seller of the futures contract to deliver a premium quality asset if they choose, in which case the final futures price is adjusted upwards by a factor of 1.1. That means that the buyer of the futures contract is getting an above standard quality asset, so therefore expects to pay a higher price. Conversely, of course, if the seller of the futures contract decides to deliver a slightly inferior quality product, a discount quality product, then the final futures price that is used to settle the futures contract is adjusted down by a factor of 0.9. In other words, the buyer of the futures contract will get the slightly inferior asset and therefore expect to pay a lower price. So let's see how this formula works. So the so-called invoice amount formula, that is the amount of cash that the buyer of the futures contract pays the seller to settle the futures contract, is the final futures price, otherwise known as the exchange delivery settlement price, the EDSP. We then multiply that by the lot size, because we know that futures prices are often quoted in dollars or cents, for example, per unit of trading. So if we had a futures contract based upon 1,000 underlying units or assets, then we have to multiply it by that number. We then take the given conversion factor, and we notice in our simple futures contract here design that there are different conversion factors that are assigned to the different types of assets that can be delivered here, whether it's class 1, class 2 or class 3. We then simply multiply that by the number of futures contracts that we've traded. So in this example, let's imagine that the last day in the life of the futures contract we have a futures settlement price of $125, which is quoted on a per unit basis. Assuming that the futures contract is based upon 1,000 underlying units or lots, that's the lot size, we multiply 125 by a factor of 1,000 then. And then let's suppose also in this example we choose, as the seller of the futures contract, to deliver class 3 of the underlying asset. We know that this has a conversion factor of 0.9, so we use that in the calculation. And let's suppose in this example we're trading 10 futures contracts. So if we multiply through them, the invoice amount, that is to say the amount of cash that the buyer of the futures contract has to pay them, will be $1,125,000. So in this example, the buyer of the futures contract ends up taking delivery of the underlying asset, which we describe as class 3. Now, it's also worth mentioning why there are a number of different classes or quality of assets to deliver into the futures contract. And this is really to avoid issues of liquidity. For example, if you just had a futures contract based upon one type of underlying asset quality to deliver, you could sometimes get the situation, particularly with commodities, where there just isn't sufficient amount of a particular quality of asset to deliver into the futures contract. So therefore, by broadening the range of assets that can be acceptable for delivery into the futures contract, you overcome liquidity constraints or squeezes in the markets. However, of course, it presents its own problem because the quality of the assets varies. So this is why futures exchanges have to come up with a mechanism in order to make the delivery process equitable, as we appreciate the quality of the underlying assets vary. So therefore, we need to come up with this idea of a conversion factor. Now, the conversion factor does vary when we look at specific asset classes like government bonds or corn or wheat or barley, but the general principle remains nonetheless. So just to summarise then, in a futures contract, the seller can choose from a list of deliverables to settle into the futures contract. They have varying qualities, therefore the final futures price needs to be adjusted to reflect that. The individual invoice amount formula, which is chosen to settle different types of underlying assets, does vary, but the general principles are the same.